What's up, family? This is your boy Ivan Hall, the Credit King. Do you know what a conventional loan is? Conventional mortgages are not backed by the federal government. Qualifying for these loans is more difficult than for government loans, but they are available to a larger range of purchasers and properties. When looking for a mortgage, you're certain to come across the terms conventional mortgage and conventional loan. After all, most lenders provide this typical mortgage kind. Conventional loans are frequently the best option for buyers with good credit who can put down at least 3% of the purchase price, if not more. Learn what conventional means in the mortgage business and whether a conventional loan is good for you. A conventional loan is one that is not guaranteed by the government, such as the Department of Veterans Affairs. Conventional mortgages frequently fulfill Fannie Mae and Freddie Mac's down payment and income standards, as well as the Federal Housing Finance Administration's FHFA lending limitations. To qualify for a traditional loan, you'll need a credit score of at least 620, however, a score of over 740 will help you receive the best rate. With a traditional loan, you may be able to make a down payment as low as 3%, depending on your financial situation and the amount you're borrowing. Federal agencies insure government-backed loans. This insurance protects the lender in the event that the borrower defaults on the loan, and it is intended to encourage lenders to provide mortgages to a broader spectrum of house purchasers. Many lenders provide conventional mortgages in addition to government-backed loans. Because conventional loans are not insured by the government, lenders consider them to be riskier, hence conventional mortgages have stricter restrictions. Government-backed mortgages come with a variety of benefits that make them more appealing to some house purchasers. There are two types of conventional mortgages, conforming and non-conforming loans. Conforming loans adhere to the rules established by Fannie Mae and Freddie Mac, two government-sponsored organizations that supply the capital to the housing market in the United States. The most well-known guideline concerns the loan's magnitude. In much of the continental United States in 2022, the conforming loan maximum for single-family houses will be $647,200. Higher-cost places, such as Hawaii and Alaska, have single-family house limitations of up to $970,800. FHA loans, or Federal Housing Administration loans, are designed to make house ownership more accessible for low to middle-income borrowers by lowering lending rules, allowing for down payments as low as 3.5%, and offering competitive interest rates. VA loans are only accessible to active duty members and veterans and are insured by the U.S. Department of Veterans Affairs. Down payments on VA loans can be as low as 0%. USDA loans are designed for properties in rural regions and are underwritten by the United States Department of Agriculture. Some low-income borrowers can also get direct loans from the USDA. Borrowers with conventional loans aren't restricted based on their income, geography, or military status. A conventional mortgage is available to anybody who meets a lender's requirements. Jumbo loans, which are for house purchasers who need to borrow more than the area's conforming limit, account for a large portion of non-conforming loans. Non-conforming loans also include those granted to borrowers with bad credit, a lot of debt, or a recent bankruptcy, as well as those made on residences with a high loan-to-value ratio, usually up to 90% for a conforming loan. Jumbo and other non-conforming loans are often charged higher rates by lenders. Due to their higher risk, these loans may have additional costs or insurance requirements. Qualifying for a conventional mortgage may be more difficult than for government-backed loans, but it may be a suitable alternative for many house purchasers. More property types. Conventional loans can be utilized for a second home or an investment property in addition to jumbo loans for more expensive residences. More control over mortgage insurance. You'll need private mortgage insurance if your down payment on a traditional loan is less than 20%. However, if your principal loan debt falls below 78% of the home's value, you can request that your PMI be canceled. Mortgage insurance costs for FHA loans, on the other hand, can endure the whole life of the loan. There are no costs associated with certain programs. Conventional loans don't have the added program-specific charges of government-backed loans, though you'll probably still have to pay fees to the lender. An FHA loan, for example, has an upfront mortgage insurance cost of 1.75%. VA loans have a financing charge of 1.4 to 2.3%, depending on your down payment. Though 30-year fixed-rate conventional mortgages are the most prevalent, different periods, such as 15 or 20-year loans, as well as adjustable-rate mortgages are available. Lenders can develop additional possibilities since they are not bound by government-mandated schemes. I hope this helps clear up what a conventional loan is. Now, go get this money.